Cryptocurrency is digital money. It exists only online. Unlike traditional money, it does not come from a central bank. Instead, it uses blockchain technology. This technology ensures security and transparency. Bitcoin was the first cryptocurrency. It was created in 2009 by an unknown person or group named Satoshi Nakamoto. Today, there are thousands of cryptocurrencies. Cryptocurrencies are decentralized. This means no single authority controls them. Decentralization reduces the risk of fraud. It also makes transactions faster and cheaper. People can send money directly to each other. No need for a bank or payment service. Blockchain is the backbone of cryptocurrencies. It is a digital ledger. It records all transactions across a network of computers. Each transaction is a block. These blocks form a chain, hence the name blockchain. Cryptocurrencies can be bought, sold, and traded. Crypto trading offers huge potential. People have made significant profits. The market is open 24/7. This means you can trade anytime. Unlike traditional markets, there is no closing time. This flexibility is appealing to many traders. Additionally, cryptocurrencies can experience rapid price changes. These fluctuations can lead to quick gains. However, crypto trading also comes with risks. The market's volatility can lead to large losses. Prices can fall as quickly as they rise. New traders must be cautious. Fear of missing out, or FOMO, can lead to poor decisions. Always remember, what goes up can also come down. Another risk is the lack of regulation. Traditional markets have rules to protect investors. The crypto market is still developing these rules. Scams and frauds are more common. Research and due diligence are your best defenses. Starting your crypto trading journey begins with setting up a trading account. First, you need to choose a cryptocurrency exchange. This is where you will buy, sell, and trade cryptocurrencies. There are many exchanges available. Look for one that is reputable and user-friendly. Popular exchanges include Binance, Coinbase, and Kraken. Once you have chosen an exchange, sign up for an account. You will need to provide personal information. This typically includes your name, email, and phone number. Some exchanges may require more details for verification. This is to comply with regulations and ensure security. Next, you will need to deposit funds into your account. Most exchanges accept bank transfers and credit cards. Some also accept PayPal and other payment methods. Be aware of the fees associated with each payment option. After funding your account, you can start trading. Familiarize yourself with the trading interface. Choosing the right exchange is crucial. It affects your trading experience and security. Start by researching the exchange's reputation. Look for reviews and feedback from other users. Ensure the exchange has a strong track record of security. Hacks and breaches have occurred in the past. A reliable exchange will have robust security measures in place. Consider the exchange's fees. Trading fees can vary significantly. Some exchanges charge a flat rate. Others have a tiered structure based on your trading volume. Also, check for deposit and withdrawal fees. These can add up and impact your profits. The range of cryptocurrencies available is another factor. Some exchanges offer a wide variety. Others may focus on the most popular coins. Ensure the exchange supports the coins you are interested in trading. Additionally, look for features like advanced trading tools and charts. Customer support is also important. Good support can make a big difference if you encounter issues. Section 5. Different types of crypto wallets. A crypto wallet is essential for storing your cryptocurrencies. The main types are hardware wallets, software wallets, and paper wallets. Hardware wallets store your private keys offline, making them very secure. Software wallets can be installed on your computer or smartphone. Paper wallets are completely offline, making them very secure from online attacks. Choose a wallet that fits your needs. Section 6. Basic trading strategies. Starting with a clear strategy is key to successful trading. One popular strategy is dollar cost averaging, or DCA. This involves investing a fixed amount regularly. For example, you might buy $100 worth of Bitcoin every week. This reduces the impact of market volatility. Over time, you average out the purchase price. Another strategy is to start small. Begin with a small investment. This allows you to learn without risking too much. As you gain experience, you can increase your investment. Day trading is another strategy. It involves buying and selling within the same day. The goal is to profit from short-term price movements. This strategy requires more time and attention. Lastly, consider holding or hodling. This means buying and holding onto your cryptocurrency for a long time. This strategy requires patience and confidence in the technology's future. Understanding candlestick charts. Candlestick charts analyze market movements. They show price action over time. Each candlestick has 4 key points. The body shows opening and closing prices. Green or white means a higher close. Red or black means a lower close. Wicks show the highest and lowest prices. Patterns indicate market trends. Reading these charts helps make informed decisions. Section 8. Support and resistance levels. Support and resistance levels are critical concepts in trading. They help you understand price movements. Support is a price level where the asset tends to stop falling. It acts as a floor. Traders expect buying interest to increase at this level. This creates a support line. Resistance is the opposite. It is a price level where the asset tends to stop rising. It acts as a ceiling. Selling interest increases at this level. This creates a resistance line. Prices often bounce between these levels. Identifying support and resistance helps with trading decisions. For example, you might buy at a support level. This is because the price is expected to rise from there. Similarly, you might sell at a resistance level. The price is likely to fall after hitting this level. These levels are not always precise. Use them as guidelines, not absolutes. Section 9. Risk management. Essential techniques. Risk management is crucial in trading. It protects your investment. One technique is setting stop-loss orders. This is an order to sell your asset at a specific price. It limits your losses if the market moves against you. Diversification is another technique. Do not put all your money into one asset. Spread your investment across different cryptocurrencies. This reduces the risk of a single asset's poor performance affecting your entire portfolio. Position sizing is also important. Only invest a small portion of your capital in each trade. This prevents large losses. For example, you might decide to risk only 1% of your capital per trade. This means a single loss does not significantly impact your overall funds. Lastly, stay disciplined. Stick to your trading plan. Avoid emotional decisions. Section 10. Ongoing education. Staying updated. The cryptocurrency market is always changing. Staying updated is essential. Follow news and developments in the industry. Websites like CoinDesk and Cointelegraph offer valuable news and insights. They cover market trends, regulations, and technological advancements. Join online communities. Forums like Reddit and Bitcoin Talk are great for discussion. You can learn from other traders' experiences. Social media platforms like Twitter also offer real-time updates. Follow influential people and organizations in the crypto space. Consider taking online courses. Platforms like Coursera and Udemy offer courses on cryptocurrency and trading. These courses can deepen your understanding. They cover topics from the basics to advanced trading techniques. Books and podcasts are also excellent resources. They provide in-depth knowledge and expert opinions. The market evolves quickly. Stay curious and open-minded. Section 11. Conclusion. Stay informed and manage risks. Starting with cryptocurrency trading can be exciting. It offers many opportunities. However, it is also risky. Begin with a clear understanding of the basics. Choose reliable platforms and secure your assets. Use trading strategies that suit your goals and risk tolerance. Always manage your risks. Set stop-loss orders and diversify your portfolio. Never invest more than you can afford to lose. Stay disciplined and avoid emotional decisions. Continuous education is key. Follow the latest news and developments. Learn from others in the community. Cryptocurrency trading requires